we spoke about this lag between the actual gold equity itself and the physical gold. And March, you're starting to see that sort of bring up now once again. That gold equity is starting to come to the surface. What's your take on how this generally moves and where we are at the moment with that?
I think this is textbook, actually. I think if you go back and look at every positive gold environment, inevitably the first thing that moves is the underlying commodity. You get the gold price to move. Investors, as they come into the sector, they tend to move first to physical gold and then to gold royalty companies, which are kind of perceived as the lowest risk, and then to large cap gold producers, mid cap gold producers, and then ultimately to developers. So we've always kind of talked about this trickle down effect. Depending on the market, that can take, 3 to 6 months, but sometimes it takes longer for, we've obviously had a big push on the physical gold side. We're starting to see that trickle down now and a lot more inflows into gold ETFs, which will tend to increase the share prices of large cap gold producers. But we're starting to see that trickling down into the gold developers as well. But the other thing is, in this environment with this gold price so high, gold producers are generating record levels of free cash flow. And ultimately, it's that free cash flow at the people who actually need the projects and need to replace reserves and need to show mine life extensions. That's the capital that's really, I think, ultimately going to recapitalize this development sector.
As a quick follow-up, that will be the difference between all the other waves and this one, right? You've got this one almost certifies that you're going to get that cash coming in.
It's already happening, and I think that's, if you look back even to 2010, 2011, it was a pretty rapid gold price run up. And you had pretty rapid cost escalation at the same time in the wake of the global financial crisis. This time, we're actually seeing the gold prices run up when inflation has stabilized and costs are stabilizing. So again, it's a massive expansion in margins. Even in the last 2 or 3 weeks, as the gold price has pushed through $3,000, no one has budgeted for this. I guarantee you there's not a gold producer in the world that has budgeted at $3,000 plus gold. This is really true excess free cash flow that ultimately is going to need to go to either back to the shareholders, or it's going to need to go to what they really need, which is adding new capacity and reserve replacement.
Excellent, Dan. Thank you very much for offering me that insight there. I could use it.